Welcome to the discussion on Chapter 8, Investment Analysis. In Chapter 7, you learned how to calculate present value, future value, annuity, and net present value. Now, some of you said, that's great. I know now how to calculate what an investment will be worth at some time in the future, but what does that have to do with the hospitality finance class? That is a very good question. So this chapter is going to begin to tie all of this together. So there are multiple things that we are going to cover here in Chapter 8. The first one is what is the core to the rest of this class for the last 3 chapters that we'll have after this Chapter 8 is the investment analysis. We're going to apply that time value of money that we learned and help to identify a market value of an asset to try and determine whether an investment is actually a good deal for us. In order to do that, we have to go back and revisit out of Chapter 6 our weighted average cost of capital. Have to explain the discount rate that creates a little bit more in depth. And again, on the second exam for this class, the discount rate will be a given number to you. You will not have to calculate, but on the final, you will have to calculate that. And then the final part of this part of the discussion, we'll look at the CAP method of valuation, capitalization method of valuation. What that does is allow us, based on our 12 months of trailing cash flow, to take an educated guess, for lack of a better description, of what the value of this asset will be at some point in the future. So the investment analysis tools that we are going to use throughout the rest of the semester focus on one payback period, which you have not seen yet. Very simple calculation, but very important. We'll explain that in a minute. The next part of this we'll cover is that net present value, which you learned to calculate. And we said if it's a positive number, it's good. If it's a negative number, it's bad. We're going to explain exactly what that means. And we'll look at that internal rate of return number, which we did not cover yet in Chapter 7, but we will today in Chapter 8. And then we'll just briefly cover the modified internal rate of return. And then we'll wrap up this chapter by just looking at a few slides that give us the factors that impact investment analysis. Just some basic rules, common sense in some ways, but with terminology you've never heard before. So sometimes you struggle with that a little bit. But that is a very good summary of what we've covered in Chapter 7 and Chapter 8. All right. So the components of an investment analysis that we're going to look at first and foremost are that weighted average cost of capital. How much money are we able to borrow and how much money do we have to raise on our own, and what are those two going to cost us? We're going to define that a little more. That helps lead us to what is called a discount rate. We touched on that in an earlier chapter. But now we need to fully understand what that means. So if we are borrowing money to do a project, if the company does not have all the cash on hand to do a purchase, we then need to go out and either raise equity or borrow money from the bank or from the Small Business Administration. And what it costs us to borrow that money becomes our discount rate. So we're going to discount those future cash flows that we're earning from owning that business, so that we can go ahead and make an educated guess on whether this is a good investment or not. So in order to take that one step further, we have to be able to assign a value to this asset at some point in the future. Generally, it's because we're going to say, all right, in year 10 or year 15 or year 20, we're going to go ahead and sell that asset. Not always, though. Sometimes it'll just be a terminal value. You'll just say, the value at 10 years will be this, and that's why we want to go ahead and do this purchase, even if we're not going to go ahead and make a sale on that. So let's go back again to Chapter 6, and let's define this weighted average cost of capital. This is used to calculate the present value of an investment, right? If we are going to go out and we are going to buy a hotel, how much is it worth today? Obviously, that's very important to us. We want to make sure that we're not going to pay more than what it costs us to borrow the money and the cash flow that is going to generate in the future. We're in business to make money, not to run a charity. So that's an important distinction there. So the rate is used to discount those future cash flows. As we mentioned in an earlier chapter, we need to get out of this idea of thinking when we buy a business that we're buying a building or we're buying vehicles or we're buying equipment. What we are buying is the ability to use those assets to generate cash flow going forward. So that mix of debt and equity, right? How much can we get the bank to give us versus how much do we have to raise in the equity market depends on how much you can borrow and pay in debt service. So the better positioned the company is with some cash to offer as collateral or its strong cash flow on its balance sheet, the more likely it is that the bank will give it a higher percentage of the money you need to buy a business, an asset, or to build a business or an asset. So let's do a little more review on this weighted average cost of capital. So this is the amount of interest expense and cash flow that we allot to equity investors divided by the amount of capital. Okay, so this takes into consideration two very important things: the capital mix. I think everybody gets that part, right? How much can we get in loans and how much do we have to raise in equity? The other part of that is the tax effect. As we mentioned in Chapter 6, the U.S. is one of the few countries that allow the interest portion of your loan note to be deducted from your income tax, which reduces your cost of borrowing money. Okay, so that is a very, very important thing. And we're going to cover that tax effect again. So what does this look like? All right, so we see here again this big formula for weighted average cost of capital. So let's define this again. All right, so what this does is the weighted average cost of capital is the weight of debt. So we're going to use the same scenario. We need $10 million to build or to purchase our hotel or build out our hotel. The weight of the debt is going to be 60%. The bank has said, based on the cash flow projections, we're willing to fund 60% of this project. So our weight of debt will be that 60%. Then the cost of debt will be that interest rate that the bank is going to charge us multiplied by the tax effect. So all of that can be reduced based on our tax rate, and we will define that a little bit more as we go forward, okay? And that gives us our weighted cost of debt. And the other half of this equation, we add to it the weight of the equity. So in our using the same example, we're getting $6 million in debt from the bank. We need to raise $4 million in equity. So the weight of equity would be that 40%. And the cost of equity would be the hurdle rate, the investor's hurdle rate. What return do they want based on their equity contributions to our company? And once we do that calculation, that makes up our discount rate. Okay, this includes the cost of debt and the investor's required return on investment. So as we mentioned in an earlier chapter, what we are going to target, what we are going to look for, is that we are going to expect, unless you are told otherwise, at least a 15% return. That is what we're going to expect out of this. A 15% return needs to be our targeted hurdle rate or return on investment. And this is used to calculate the present value of an asset by discounting each year's cash flow so that we understand it. Now the CAP method for today, all we're going to do, we're going to come back to this after the second exam, is we are going to use the CAP method to value the assets prior 12 months cash flow. Provides the assets approximate market value. So by using the 12 months of cash flow and using a cap rate, right, which is based on the cash flow and historical averages, we then can go ahead and calculate the approximate market value of an asset. We will do the actual calculations when we get to a later chapter, but for right now, that's what we need to know, is that there is a way to calculate that end value or the current value of an asset.